Hello everyone, this is Jimmy Singh, broker owner with Supermax Realty in London, Ontario, Canada. So today we'd like to discuss down payment options for first time home buyers in Canada. So let's say somebody is looking to buy first home in London. At least you can buy something for $500,000. I'm not sure you can buy something in bigger cities like Toronto, but one thing you have to keep in mind is if you're buying a property worth $500,000 or less, you can buy that with only 5% down. So simple calculation is, let's say your house is worth $500,000, you multiply by 0.05, so it will give you the exact amount. So in our example, the house is worth $500,000, so if we take this one and multiply by 0.05, it will give you 25,000. So 5% of this amount is 25,000. That is the minimum down payment you require to purchase a house in Canada. If your house is worth more than $500,000 up to less than million, then the down payment breakdown is 5% up till $500,000. Then you require 10% up till you reach 999,999. So this is basically how it works. There's a couple of calculators online. You can go to Canadian Mortgage Housing Corporation. They will make the calculations easy for you. So I just want to break it down because there are certain finer points which sometimes first time buyers don't understand. Maybe some agents don't explain them properly and they go to the lawyers at closing and they see certain expenses. They're kind of surprised. So here is what it is. So if you're doing 5% down, $500,000 makes 25,000 down. 10% of that amount is 50,000, and if you do 20% down, the amount would be 100,000. So one thing, guys, as a first-time buyer, you have to be aware to make the house affordable and within the reach of a public or a first-time couple or a first-time professional. The government insure these mortgages. So let's say if you don't have 20% down, government says, okay, you can still buy with 5% down, but then market is cyclic. It can go up and it can also go down. So to protect the lenders, the people who give you money, they can be banks or credit unions, you have to pay insurance to protect the lender in case somebody default on the mortgage. So there's all different kind of calculations, but to make your life easy, insurance premium is added to the amount. So premium can be up to 4%. So in this example, your mortgage insurance will be $19,000, but you're just paying 5% down, at least you become a homeowner. Because to save $25,000 is easier than to save $50,000. And if you do more down payment, your premium goes down, folks. So if you see here with 10% down, your premium is $13,950. And the good part is, if you're doing 20% down, there is no insurance required, because then the lender feels they have less risk and you have a lot of skin in the game, so you are more responsible person, you won't default, right? So total mortgage, guys, is basically $494. Some people might be surprised, hey, I'm putting 25,000 down, so 25 if I subtract from $500,000, it should be 475. So what happened? So what actually happened is, yes, you're taking out 25,000 from $500,000, but that mortgage insurance is added. So your total mortgage will be 494. So when you go to your lawyer to sign it, you might be expecting, okay, I put 25,000 down, so I will be getting a letter from my lender saying 475,000, but that is not the case, because you are insured and you're paying premium of 19,000, which is added. So your total mortgage when you get your keys would be 494. If you put 10,000, so basically you're putting 50,000 down, but then the 13,950 is added. So total mortgage would be 463,950. But 20% down, no premium, so you will have a 400,000 mortgage. Another kicker which I want to tell you is, sometimes people go to the lawyer, maybe it was not explained to them. There is sale tax on the insurance. Let's say I live in Ontario, Canada, so we will pay 8% tax on the insurance amount. So let's say the insurance amount is $19,000 for the mortgage. So 8% of that comes out to be 1520. The good part is this premium is added to the mortgage and spread over the life of the mortgage, which can be 25 years up to 30 years. So you don't have to sweat on it. You don't have to come out from your pocket this cash, because that amount is put in the mortgage and spread for 25 years. You can go in the house and build your equity. But yes, the sale tax, when you go on closing, I will make another video what are the closing costs. So one of the costs you have to be aware is 8% sale tax on your insurance premium, which is 19,000. So 8% of that is 1520, and if you take 8% of this amount, it will be $1,116. And obviously there's no insurance premium, so you don't pay any sale tax. Another thing, guys, I want to tell about is home buyer plan. So in Canada, the government want people to buy their own house if they want to, and if you are putting money after earning your income in your RRSP, which is kind of retirement fund. So they said, hey, if you're a single working professional, you're putting money in your RSP, you can withdraw up to $35,000. So let's say you're a couple, so 35,000 is drawn by one person, 35% is drawn by other. So it is basically $70,000 tax-free money. Because when you put money in the RSP, you get a write-off in the year where you put the money for your retirement to bring your tax bracket down. And as I said, 70,000 for a couple or a single professional, 35,000 you can put towards your down payment. And yes, you have to put the money back in RRSP. It will be 15 years. So when you draw $35,000, you get a write-off from CRA, and then you have to pay all the money back within the next 15 years. So just keep those two numbers in mind. You'll be all good. And if you have any more questions, you can always call our office, Supermax Realty in London. My number is 519-933-2559. And now let's do another example with a higher price point of the property. Alright folks, so let's do another example. Now the purchase price is $900,000. So as we discussed in the previous example, if you're purchasing a property less than $500,000, you just need 5% down. But if the price is between $500,000 and $1 million, then for first $500,000 you have to put 5% down, and balance you have to pay 10%. And if the property goes beyond million, 1.1, 1.5, 2 million, then you have to put more than 20% down. So to keep your life easy, so we have to blend these two calculations. So for 900,000 property, minimum down payment which you need is 7.23%. We can't buy with 5% down. It has to be blend of both. So that comes out to be $65,070. With 10% it is $90,000. With 20 it is $180,000. Again, the mortgage insurance, anytime you're doing less than 20% down payment, you have to pay a mortgage premium. In this case, it is $33,000 down, $33,397,000. Yes, it is a big premium, folks, because this premium is added to your mortgage and stretch over 25 years. And if you're paying a mortgage of, let's say, 5%, 6% interest rate, you're also paying interest on this premium. Yes, for some people it is an option to borrow money from their parents, or you maybe buy a house with your friends, or maybe 2-3 people come together to put more down payment to get rid of this mortgage insurance. But then again, there are some people, they don't have any family in Canada, or they don't have resources to pool money together. Then you have to pay this insurance premium with 7.23%. With 10%, your premium goes down to $25,110. 20% down, no premium. Total mortgage again, guys. So basically 900,000. You put this down payment, plus you have to add this. Take this amount, subtract 65,000, plus add this premium. So total mortgage will be $868,327,000. With 10% down, again you take this amount, subtract your down payment, add 25,000, which is an insurance premium. It comes out to be $835,100 Then again, if you do 20% down, there's no premium. So basically this is your balance. See, here is this thing. Nobody likes to overpay anything in life. And yes, some people might feel insurance premium is a lot, but here is my thought. I remember my first house when I bought, I did less than 20% down. I get into home ownership. I kept the property for a few years and then I moved to the next property. That time I put all the appreciation I made in that property, and then I don't have to go in insured mortgages, meaning your equity grows up, you stay in the property 5, 7, 10 years, take all the money, put to the next house, and then you won't have to pay premium, but at least it will get you into home ownership. Sale tax again, guys, in life, tax is something that is constant. So we have to pay 8% tax on our insurance premium. In this case is 33,397. You multiply by 0.08, so it is $2,600.71. In this case, the sales tax is 2008, and then obviously this is an insured mortgage, you don't have to pay. I hope you like the video. It is basic, analysis, what you can expect as a first-time buyer. I will create more videos down the line for down payments, what are the hidden costs if you're a first-time buyer buying a pre-construction or a resale home. And my name is Jimmy Singh. I'm a broker owner for Supermax Realty in London. So if you're looking to purchase property anywhere in Greater Toronto area, Golden Horseshoe, our team serves all the way from Niagara Falls all the way to Windsor, inclusive of GTA. You can reach me directly at my cell phone 647-961-2639, or you can visit my website www.supermaxrealty.ca. Or if you're a first-time viewer at my channel YouTube, please subscribe and leave your comments. It is Real Estate Edge with Jimmy Singh. Thanks for watching.